So then you have a interest rate increase over that period that causes the house values to finally begin to taper off, and the deleveraging process begins because people can't afford to carry that much debt. They had credit card debt and so forth. So that's part of the process, and that's actually going on now. Part of the deleveraging, that is the elimination of debt, is because of bankruptcies. Part of it is because people walked away from their homes. That's the foreclosure issue that we have. And even with all that, we still have well over 100% debt to disposable income in this country. So we're still pretty badly leveraged. And people are recognizing that in many ways because as incomes have grown, even though consumption has increased, our savings rate has risen as well. It was almost zero. It's now between 5 and 6%. So that process is going to continue to take place. Now, businesses weren't as leveraged. That is what I call real businesses, the real economy businesses, and they're adjusting pretty well. They have good cash balances. And then the third segment, and this is the killer, was the financial industry and the largest institutions. They leveraged worse than the consumer. Now, if you think about it, and I'll give you an example, the largest 20, let's say, and these are approximate numbers, but not far off. When this period started in the early 2000s, 2002, the leverage ratio, that is the total number of assets to real equity capital, was around 17 to 1. And by the time the crisis began to emerge, it was over anywhere between 23 to 1 to 40 to 1. Depending on which institution. So they had borrowed extensively. The crisis hits, you have this carry, and it's very short-term debt, which is the worst stuff, because it runs quickly. And so you have that deleveraging take place, and they've been rebuilding capital. Now, part of the reason we talk about a credit crunch is demand, because the economy went through a recession, and people didn't have enough. And part of it is supply, because these largest banks have had to rebuild their capital. And when you rebuild capital, you don't grow your assets. You build your capital so your ratios come back in, and so you hold off on lending at that point. So you have those two forces coming together. That process in the banking industry continues, but now more modestly because they have replenished their capital through earnings and through help from the taxpayer. That's just a fact. And we are in the process of deleveraging in an orderly fashion, and it has to continue. And the Federal Reserve has helped do that. That's been a positive. So that's the deleveraging issue that goes on. Now, what deleveraging means, though, is that you probably do have a lower growth rate. As an economy goes, your consumer can't consume at 5% on an annual basis anymore because it can't borrow all that money to buy all those boats and cars and whatever, summer homes and so forth. They have to wait on that. But they're still buying. They're buying the basics. They're buying some of this. And so our consumer is still an important part of the economy and helping us recover. But it's got to be more slow than it was in the boom period. Businesses are waiting for the consumer to make sure they adjust, and we're seeing some expansion in the business. And that will get better with time if the economy continues to grow and people have confidence that it will grow. So that's the leveraging question we have to get used to. Now, unemployment. Unemployment is too high. It's 8.8%. But first of all, the unemployment relative to the dual mandate. So let's talk about the dual mandate first. The dual mandate, for those of you who don't know, is assigned by the Congress of the United States to the Federal Reserve System. But I think of the dual mandate different than others. I guess not uncommon for me. But anyway, it's a little bit different. I think of it as a long-term mandate because the law says that the central bank, the Federal Reserve, will conduct policy in a way that is consistent with maintaining long-term potential growth of its economy with long-term stable prices and stable employment and stable interest rates. The orientation is to the long term and stability. And I'm very comfortable with that because you have to take the long term view. Now, here we are then. You've got the issue of employment. Well, you have to think, what's the structure of the economy and what have we gone through? Well, the unemployment rate, when you break it down, the highest unemployment rate are for individuals without a high school diploma in this country. It's near 15%. This is the official number, near 15%. The unemployment rate for the high school graduate is high. It's about 9%, I believe. For some colleges, a little bit lower than that. And then college, the unemployment rate, that is college degree or above, is about 4.5%. All right. Now, we have to think about, okay, can monetary policy address that? Well, it can if we have a good manufacturing base, and we can grow that base, and I think we can, but that's going to take time because we've offshored a lot of our manufacturing. But I think that's something we should focus on. But that's not a monetary deal. That's a policy, rule of law, business environment that you create, and so forth. Now, I think that's possible because the United States, compared to every other country in the globe, is the most entrepreneurial country there is. We have more startups. That's where our major job growth has always come, in the startup side. Now, we have very low unemployment among professionals, remember, but the others, in terms of industrial opportunity, I think it's there as well. So we can grow that. But that's the entrepreneurship, and whether we allow that to go. Now, that brings in another set of questions. I worry a great deal, as was mentioned in the introduction, about the fact that we are changing the structure of our financial system. This country, for 200 years, was built on a great distrust of concentrated power, and I think with good reason. And what we've had over our history are large institutions, very large, to small community banks. And in the middle are regional banks. We have them in this region. We have them in the 10th District as well. And what you have with that is the ability to fund our largest firms, the GMs, if they're, or Fords, and you have large institutions. We have regional institutions that are funded by regional banks, and we have small startups and others, community banks. And we need to think about that as we go to policy, because what we've introduced in this country with this bailout of these largest institutions, and I know they're important, is we've changed the game. It's advantage size. So you now have size pursued not because there are efficiencies that are won, but because there is size that gains advantage. And that's what we need to change. We need to have the same capital standards whether you're large or small. And if you fail, whether you're large or small, you are allowed to fail. That's what capitalism is all about. And when you interfere with that process, then you change the game in favor of someone. And then it becomes a political game. And if you see the size and the importance and the political power of these largest institutions, you see what I mean there. So we have to be thinking about that as we think about the future. What is the financial structure that we want to match the industrial sector and the manufacturing sector and the entrepreneurial sector of this economy? And if we do that and we say, no, we want it to be fair, then we will, in fact, begin to level the playing field on the financial side so that we can level and assure ourselves of a vibrant, dynamic economy on the so-called real side. So that's my answer to manufacturing and growth, my answer to the dynamics of an economy and the strength of the economy. Those are the things that matter every bit as much as monetary policy. We have 7 minutes left. And if one more question, and the way I'm answering them, it'll take 7 minutes to answer, so I apologize.
Yes. A question on the deleveraging.
Yes. Wave at me. I can't. Okay. Thank you.
I'm sorry. As we try to deleverage, we're probably likely to come into a liquidity shift. And if that happens at the same time that we see interest rate shifts, is there a possibility that we're going to find ourselves in the process of deleveraging, of literally bankrupting our own system?
Well, now I need to know what you mean by liquidity shift.
Basically, the time preference for money.
Okay.
I mean, what Paul Hussman and some others have, or John Paul and some others are starting to say that this is front-end loaded. And if you get into this too fast, too early,
Right.
the preference for time value of money is going to shift on you,
Right.
forcing the interest rate up and undercutting the value of your asset.
Right. That's a risk. But now, you have to consider what the risk of that is now versus if you let the current policy embed itself further into the system where you get more of the economy based upon the assurances that interest rates will be zero forever. And when you get decisions around that, then you really do begin to shift the liquidity picture out there. And you get the idea of borrowing short and lending long embedded even to greater extent. Your mismatches become more pronounced so that when you do make even the smallest adjustment, you cause literally a reshifting and a very dramatic adjustment in the economy that brings you into a recession. Now, in a way, that's what happened in 1937, but that wasn't a little adjustment. That was a huge adjustment that was imposed. So there's two things. The size of the adjustment will be a factor, and the duration before we introduce the adjustment will be a factor. I think the smaller, the sooner, then you get expectations generating, and you get people thinking about, wait a minute, I better match my assets and liabilities, because if I don't, I'm going to find myself in trouble. I better make sure that my stress test, if you will, allows me to make sure I can service that debt if rates go to this point, because now I know that nothing in life is guaranteed. So I think you're better off by making it. Now, I mean small, because you do have this deleveraging going on, and you want to make sure that stays orderly. Or it hasn't been particularly orderly if you look at the foreclosures, but it doesn't become more chaotic than it is right now. So, ladies and gentlemen, what a pleasure for me to be here. Thank you for the wonderful questions and for your attention during the program and for allowing an Iowa State guy in this wonderful, wonderful auditorium. Thank you all.